So you have $10,000 and you're ready to invest it. Here's the thing though, ready according to who? Because $10,000 sitting in your account and $10,000 that is actually free to invest are not always the same thing. And most people never stop to ask the difference. They see the number, they feel the momentum, they want to do something with it, which makes complete sense. But wanting to invest and being in the right position to invest, those are two different places to be standing. And if you skip that question, you can do everything right. Pick the right accounts, choose the right funds, stay consistent, and still find yourself barely moving a year from now, wondering what went wrong. What you need before anything else is a system that tells you where you actually stand and what this money needs to do first. My name is Mila, and I'm obsessed with the small moves and hidden nuances that build real wealth. Today, I'm going to show you exactly how to allocate your first $10,000. What comes first, what comes next, and what to keep small until you're ready. Here is how this system works. It has two parts, and both of them matter. The first part is the hierarchy. The second part is the allocation. And you cannot do the second one well without understanding the first one. The hierarchy tells you how to think about your money. The allocation tells you where to actually put it. One is the logic, the other is the action. And when people skip straight to the action without the logic, that is usually where things go wrong. So that is the flow. Hierarchy first, allocation second. The hierarchy has 3 layers: secure, build, and boost. And the order is the point. Let's start with the hierarchy. First layer, secure. The first layer is called secure, and this is the one most people want to skip. Not because they don't understand it, because it doesn't feel like investing. It doesn't feel like your money is doing anything exciting. And when you have $10,000 and you're ready to build something, exciting is what you're looking for. But here is the truth about secure. It is not where your money goes to sit. It is what makes everything else work. Because without it, every dollar you put into the layers above it is sitting on an unstable base. And unstable bases collapse, usually at the worst possible time. Secure covers 3 things: high interest debt, your emergency fund, and liquidity, meaning enough accessible cash that a real-life expense doesn't force you to pull from your investments before they've had time to grow. Think of it this way. If any of those 3 things are unresolved, your money has a leak, and you cannot build pressure in a system that is leaking. Secure is how you seal it. Second layer, build. The second layer is build, and honestly, this is the layer you came here for. This is what you had in mind the moment you decided to do something with your $10,000. And that makes sense. Build is where your money starts growing. This is the layer most people picture when they think about investing, and they are not wrong. They are just early, because most people arrive at build before they have finished secure. And build needs that foundation underneath it to function properly. The biggest enemy of a long-term investment is being forced to touch it too soon. When your foundation is solid, debt managed, emergency fund in place, your build money can actually do its job. It can sit, it can compound, it can grow without interruption. Build is your core wealth engine. This is where you put money into assets that grow over time: index funds, retirement accounts, diversified market positions. The kinds of investments that don't make for exciting conversation, but are responsible for most of the real wealth that gets built over a lifetime. Build is not about finding the best performing stock or predicting what the market does next year. It is about consistency and time. And those 2 things together are more powerful than almost any specific investment decision you will ever make. Third layer, boost. The third layer is boost, and this is the one that gets the most attention, usually for the wrong reasons. Boost is where most people want to start. It is the layer that looks like the fast track: crypto, speculative stocks, funding a business idea, investing in a skill that could dramatically increase your income. High risk, high potential, high excitement. And when you have $10,000 and you are watching other people talk about what they made on one trade, boost is incredibly easy to run toward. But here is what boost actually is. It is a top layer, not a foundation, not an entry point, a top layer, meaning it only makes sense once what is underneath it is already solid. Because boost can go up significantly, it can also go down significantly. And if boost is sitting on top of nothing, no emergency fund, unresolved debt, no core investments growing quietly in the background, then a bad outcome in this layer doesn't just hurt your boost, it destabilizes everything. You end up pulling from places you shouldn't, making decisions from a place of panic, and undoing progress you haven't even built yet. Boost is not the enemy. Used correctly, at the right size, at the right time, it is genuinely powerful. The key words are right size and right time. Boost is not where you start, it is where you get to. Now you understand the hierarchy. 3 layers: secure, build, boost. The logic is clear. The harder question is, given where you actually are right now, how do you divide your $10,000 across them? That is what the allocation answers. And because everyone's starting point looks different, we are going to walk through 3 real scenarios so you can find yourself in one of them. One important thing before we begin: the specific numbers I use in each scenario are examples. Your actual figures will be different. What matters is not the exact number. It is the logic behind how the money is being divided and why. Let's go. Scenario 1: unstable. Scenario 1 is called unstable and sits firmly in layer 1, secure. And the reason for that name is simple. At this point, your foundation has not been established yet. Your money does not have solid ground underneath it. And there are 3 ways you can identify this easily. The first is no real emergency fund. The second is high-interest debt. And the third is a shaky cash and liquidity situation, meaning the money available to you for everyday life is not secure enough to handle real life without putting you under pressure. If those 3 things are true for you right now, this is your scenario. Now, before we talk about how your $10,000 gets allocated here, there is something important to understand. The order in which you address these 3 things matters. It is not just what you do. It is what you do first, second, and third. Because doing them in the wrong sequence can put you right back where you started. The system only works when the flow is right. So let's walk through each one. Step 1. Starter Emergency Fund. The first thing that leaves your $10,000 is not going into the market. It is $1,000 going straight into a starter emergency fund. And I know that is not what you were expecting to hear. You came here with $10,000 ready to put it to work. But here is why this move comes first. If you skip this step and go straight to investing or even clearing debt, which is the next thing we are going to talk about, you are leaving yourself with no buffer. So the moment something unexpected happens, a car repair, a medical bill, a month where something just goes wrong, you have nowhere to go except back to the credit card. And everything you are about to pay off starts rebuilding itself immediately. $1,000 breaks that cycle. It sits in a separate account, not your main account where it quietly disappears into everyday spending. A standalone account that you do not touch unless something real happens. It is not a full emergency fund. We will build that properly once the next step is cleared. Right now, its only job is to make sure that when life happens, you have a buffer that stops you from undoing the progress you're about to make. So from your $10,000, $1,000 is set aside immediately. That leaves $9,000. And now we talk about the debt. Step 2, high-interest debt. Now let's talk about the debt, because this is the section that is going to change how you think about your $10,000 completely. When I say high-interest debt, I want to be specific. High interest is anything sitting in double digits, 10% and above, credit cards, personal loans, buy, now pay later balances. If the rate has 2 digits in front of the decimal point, it qualifies. Here is the mistake most people in this scenario make. They have $10,000, they have debt, and they decide to keep them separate. The $10,000 goes into investments. The debt gets the minimum payment every month. The thinking is, my money is growing on one side, I am handling the debt on the other. Eventually, it balances out. Let's look at what actually happens. You have $5,000 in credit card debt at 20% interest. You invest your full $10,000 and the market has a good year. 8% return. You earn $800. That feels like progress. But that $5,000 balance at 20% has just cost you $1,000 in interest over that same year. You earned $800. You lost $1,000. You are $200 down on the year. Your investment account went up and your net worth went down. Both things happened at the same time and you did not even see it. That is not investing. That is losing ground while feeling like you are winning. Now flip it. You take $5,000 from your $10,000, clear the balance completely, and invest the remaining $5,000. Your 8% return gives you $400. But this time, there is no interest eating into it. That $400 is entirely yours. And from this point forward, every dollar you earn from your investments has nothing pulling against it. Same $10,000. Completely different outcome. So the second thing that leaves your $10,000 in scenario 1 is debt clearance. Whatever clears that high interest balance, that goes next. And what remains after that is where we build properly. Step 3, full emergency fund and liquidity. So the debt is cleared. Your starter emergency fund is sitting separately. And whatever is left from your $10,000 is ready to move. But before anything goes into investing, we need to finish what we started with that emergency fund. Your target is 3 to 6 months of essential expenses: rent, food, utilities, transport. The things that have to be paid no matter what. That is your number. And here's the part most people do not realize. Your emergency fund does not just sit there doing nothing. It goes into a high-yield savings account earning 4 to 5% guaranteed. So, while it is protecting you, it is quietly growing at the same time. Now, I know what you are thinking. 4 to 5% is not 8%. The market returns more. Why not just invest it? Because the question is not 4 to 5% versus 8%. The question is 4 to 5% versus what actually happens if you do not have it. Here is what happens. Something goes wrong. A car repair, a medical bill, a month where your income dips. You have no buffer, so you reach for the credit card. The same credit card you just paid off. And just like that, you are back at 20% interest undoing everything you built. The 3% difference between the high yield and the market is nothing. Nothing. Compared to the 20% you just escaped. The emergency fund is not the low-return option. It is the option that makes sure you never go backwards again. So, whatever remains from your $10,000 after debt clearance goes into that high-yield account building toward your 3 to 6 month target. You may not hit the full amount from this $10,000 alone. The rest gets built from income month by month. What matters is that it is started, it is earning, and it is protecting everything above it. So that is what your $10,000 does in scenario 1. It clears the debt and builds the emergency fund in a high-yield account earning 4 to 5%. Not glamorous, but solid. And solid is what makes everything that comes next actually work. Once that foundation is in place, that is when you move into scenario 2. And that is where the real investing begins. Scenario 2, stable beginner. Scenario 2 is called stable beginner. And if scenario 1 was about building the ground underneath you, scenario 2 is where you finally get to build on top of it. You know, this is your scenario if 3 things are true. The first is that your high-interest debt is cleared. The second is that your emergency fund is funded and sitting in a high-yield account. And the third is that your cash and liquidity situation is stable. Everyday life is covered, and one unexpected expense is not enough to derail you. If those 3 things are true, you are ready. Not almost ready. Actually ready. In scenario 2, you are now firmly in the middle layer of the hierarchy, build. And build is not one single investment. It has 3 parts: core, growth, and income. And understanding how those 3 parts work together is what makes the difference between investing your $10,000 well and just picking something and hoping. Let's start with core. Core is the foundation of your build layer, and it takes the largest portion of your $10,000, roughly 60 to 70%. This goes into index funds. An index fund holds a small piece of hundreds or even thousands of companies at once. So instead of betting on one company, you are spreading across the entire market. When the market grows, your investment grows with it. Historically, that has averaged 8% per year over the long term. On 60% of your $10,000, $6,000, at 8% annual return, that is $480 in year 1. That number on its own does not sound dramatic, but that return does not just sit there. It compounds. Next year, you earn 8% on $6,000 plus last year's return. The year after that, on top of that. Over 10 years, that $6,000 alone grows to approximately $12,950 without adding another dollar. Over 20 years, it becomes close to $27,970. That is not because anything exciting happened. That is because it was left alone. Core is not where you try to be clever. It is where you are consistent. The second part is growth. This takes roughly 20 to 25% of your $10,000, around $2,000 to $2,500. Growth positions are investments that have the potential to return significantly more than your core index fund. Technology-focused ETFs are the most common example. Funds that hold companies like Apple, Microsoft, Nvidia, Google. These are not random bets. They are sectors with a track record of growing faster than the broader market. Where your core index fund averages 8%, a technology-focused fund has historically returned 12 to 15% in strong years. But here's the honest side of that. The same fund that returns 15% in a strong year can drop 20 to 30% in a weak one. It moves faster in both directions, which is exactly why it sits alongside core and not in place of it. Core keeps you steady when growth gets volatile. Growth gives you the upside that core alone cannot. Think of it this way. Your core is the foundation. Growth is the engine that pushes your build layer further than consistency alone can take it. The third part is income. This takes the remaining 10 to 15%, $1,000 to $1,500. And this one works differently from everything else in your build layer. Income positions, dividend-paying stocks and bonds, do not grow dramatically. That is not their job. Their job is to generate consistent returns regardless of what the market is doing. Let me explain how that actually works. A dividend-paying asset is a stock or fund that pays you a percentage of its value on a regular basis, quarterly or annually, simply for holding it. You do not have to sell anything. You do not have to time anything. You just hold it and the payment arrives. On $1,000 in a dividend fund paying 4% annually, that is $40 a year. That sounds small, but here is what matters. That $40 arrives whether the market is up or down. And that is the real value of income inside your build layer. When the market drops, and it will drop, that is not a prediction. That is just how markets work. Most beginners panic. They watch their core and growth positions go red, and every instinct tells them to pull out. The income layer is what keeps you steady, because while everything else is moving, your dividend payment still lands. That consistency is not just financial, it is psychological. It is the thing that stops you from making an emotional decision that undoes months of progress. Bonds work similarly. A bond pays a fixed rate over a set period regardless of market conditions. Predictable, stable, unaffected by volatility. Neither is exciting. Both are stabilizing. And in a build layer that is designed to compound quietly over time, stability is not a weakness. It is the foundation that lets everything else do its job. So your 10,000 in scenario 2 looks like this. 60 to 70% into core, 20 to 25% into growth, 10 to 15% into income. 3 parts working together, each one doing a different job, none of them requiring you to watch the market every day. That is build. Consistent, compounding, and uninterrupted. Scenario 2 does not need boost yet. And that is not a limitation. That is the correct decision for someone at this stage. Build needs time to establish itself before anything sits on top of it. When your build position is growing consistently and your foundation is solid, that is when you move into Scenario 3. And Scenario 3 is where boost enters the picture. Scenario 3, accelerate. Scenario 3 is called accelerate. And in this scenario, you are now in the top layer of the hierarchy, boost. You know this is your scenario if build is already in motion. Your core, growth, and income positions are established. Your foundation is solid. Your money is compounding quietly in the background. And you are sitting with your $10,000 thinking, I want more than that. Not instead of what I have built, on top of it. That is exactly what Scenario 3 is for. And within this scenario, there are 2 levels. Because boost looks different depending on where you are and what your biggest lever for growth actually is right now. Level 1 is for the viewer who is ready to take calculated risks in the market. Level 2 is for the viewer whose biggest opportunity for growth is not in the market at all. It is in themselves. Let's start with Level 1. Scenario 3, Level 1. So, let's talk about Level 1. And this is the level where things get interesting. You want more than 8%. Not instead of what you have built, on top of it. That is not greed. That is strategy, as long as what sits underneath it stays untouched. So here is how your 10,000 divides at this level. The majority, 75 to 80%, stays in build. Everything you have already built, your core position, your growth slice, your income layer, running quietly in the background the way it is supposed to. That does not change. What changes is that 20 to 25% of your 10,000 now goes into boost. And boost at this level has 2 expressions. The first one is speculative market positions. Individual stocks, sector-specific funds, emerging markets. Higher potential returns, higher volatility. These are calculated bets, not random picks. The people who bought Nvidia early when it looked like just a gaming chip company, or Amazon when it looked like just an online bookstore, those were speculative positions, calculated ones, sized correctly, and the sizing is exactly what made the difference. You put 20% of your $10,000, $2,000 into a speculative position and it drops 40%. That is an $800 loss. Painful. But your $8,000 in build is still compounding. You absorb it and you move forward. Now, flip it. You put 80%, $8,000, into that same position and it drops 40%. That is a $3,200 loss. Your foundation is shaking. One decision sized incorrectly, and everything underneath it feels it. That is why Boost has a defined size. The second expression is crypto, and this one needs its own moment. Crypto belongs in Boost and only in Boost. It gets a small defined slice, 5 to 10% of your total allocation, and nothing more. Here is why that number matters. You put 5% of your $10,500 into crypto and it goes to zero. That is a $500 loss. Painful but survivable. Your build is untouched. You move forward. Now flip it. You put 80%, $8,000, into crypto and it goes to zero. Not drops, not corrects, zero. Your build is gone. Everything you built in scenario 2 has been wiped out by one position that was never supposed to be that large. Same asset, same outcome, completely different consequences based purely on how much you put in. That is why crypto has a defined size. Not because the upside is not real. It is. But because the downside has to be survivable. So your 10,000 in level 1 looks like this: 75 to 80% into build, and 20 to 25% into boost. Split between speculative positions and crypto based on your risk tolerance. Everything sized, everything defined. Controlled upside, solid base. That is level 1. Scenario 3. Level 2. Now, level 2 is a different kind of conversation. And honestly, it is the one most people are not expecting in a video about investing. Because level 2 is not about the market at all. It is about you. Here is the thinking. At this point, your build is running, your boost layer has some skin in the game, but you are sitting with $10,000, and the honest question is, what is the highest return available to you right now? And for some people, the answer is not a fund. It is not a stock. It is not even crypto. It is their income. Think about it this way. If you are earning $50,000 a year and you invest $10,000 at 8%, that is $800 in returns over the first year. Meaningful. But if that same $10,000 goes into a skill, a qualification, a business, something that moves your income from $50,000 to $70,000, that is $20,000 in additional annual earnings. Every year, from one decision. No index fund at this level competes with that. This is what is called human capital. And it is the most underused asset most people are sitting on. Your ability to earn is itself an investment. And at certain points in your financial journey, particularly when your income is the biggest lever available to you, allocating toward that ability makes more financial sense than almost anything else. Also, in level 2, your 10,000 divides like this. A solid portion still goes into build. You do not abandon what is compounding. A smaller slice stays in boost, but a meaningful portion, and what that looks like depends entirely on your situation, goes into whatever moves your income up. A certification, a course, launching something, building something, whatever closes the gap between what you earn now and what you are capable of earning. Because here's the thing about wealth that most people figure out too late. The market builds your money. Your income builds your life. And when you invest in the thing that grows your income, you are not choosing between the two. You are accelerating both. That is level 2. That is scenario 3. And that is accelerate, execution. So now you know where you stand. 1, you know how your 10,000 divides. Now let's talk about how you actually do it. The first thing is this. Do not put it all in at once, even if you know exactly where it is going. Dumping your full allocation into the market in one single moment exposes you to whatever the market is doing that day. Instead, spread it out over a couple of months. That is called dollar cost averaging, and what it does is simple. Sometimes you buy when the market is high, sometimes when it is low, and over time it averages out. It removes the pressure of trying to time the market perfectly, which nobody does consistently, not even the people who say they do. The second thing is automation. Once you know your allocation, set it up to happen automatically. A fixed amount leaving your account on a fixed date every month going exactly where it is supposed to go. The moment investing becomes a manual decision, it becomes something you can talk yourself out of. Automation removes the decision entirely. It just happens. And the third thing, keep secure liquid. Your emergency fund stays in the high-yield account. It does not get moved into investments because the market looks good. It does not get touched because an opportunity feels urgent. It sits exactly where it is supposed to sit and does its one job, protecting everything above it. That is it. 3 things. Simple, consistent, and exactly what your 10,000 needs to actually work. So let's go back to where we started. If you had $10,000 right now, what would you do with it? That was the question. And the honest answer is that most people approach that question looking for a single answer. One investment, one move, the right pick. And that framing is exactly what makes $10,000 feel harder to manage than it actually is. What you have now is something different. You have a system, a hierarchy that tells you how to think about your money, and an allocation that tells you where to put it. You know whether you are in secure, build, or boost. You know what your money needs to do first. And you know that the right answer for you is not the same as the right answer for someone else with the same amount. Because where you are standing is what determines how it divides. That is the shift. From guessing to structuring. From one big intimidating decision to a clear sequence of smaller ones that build on each other. Your first 10,000 is not just money, it is the point where you stop reacting to your finances and start directing them. And that, more than any single investment you will ever make, is what changes everything. If this helped you get clear on where you stand, share it with someone who has been sitting on the same question. And if you want to go deeper on building real wealth in a way that actually fits your life, subscribe. There is a lot more where this came from. And always remember, luxury is easier when your money is organized. I will see you in the next one, and I love you.